Analizamos. Eric Lynch is Managing Director, Investment Committee in Scharf Investments. Eric, thank you so much for having us a few minutes.
Thank you for having me. Listen to my English.
Eric, the minutes from the Fed policy meeting on June underscored that the central bank members are increasingly concerned that the elevated pace of inflation is becoming quite persistent. Officials concluded that a restrictive policy stance is required to tame inflation. These minutes read hawkish, but are they out of date?
They could be a little bit out of date, of course. It's a great question. Certainly, if you look at a very interesting data point from the Atlanta Fed, they have a GDP now, which is kind of a real-time GDP assessment algorithm. And on June 1st, they were expecting roughly a 1% type GDP growth rate for the US for Q2. And by the end of the month, early July actually, so in 1 month's time, they were expecting maybe negative 2%. So we could be in a recession in the US. That certainly might make the Fed at least pause the magnitude of their increases, but we'll have to see. I think we also have to keep in mind that the Fed definitely has two mandates. One is price stability and one is full employment. We are at full employment. We are not anywhere near price stability. And if you look at the U.S. confidence, consumer confidence levels, we're at an all-time low because the average consumer is being hit very hard by inflation.
And well, you mentioned this indicator, the GDP now from Atlanta Fed, with this negative 2% that sees now from two quarter. Do the Fed minutes reflect the current reality of the economy?
Probably not. You know, the June minutes probably don't reflect the speed of that decline. So I wouldn't be I think there was a concern that we're definitely be at a 75 basis points increase for the next Fed meeting later this month. It could be a little bit less than that. We'll have to see. But keep in mind the economy is still pretty strong, relatively speaking. Leading economic indicators, while slowing, are still trending positive. The ISM manufacturing data was positive. So, I think investors need to be careful not to anchor themselves too much in the last 20 years of the Fed saving them and their asset prices, because what's different this time clearly is that every time the Fed's dialed back their monetary stimulus kind of tightening, they've been able to do that because there was no inflation at all, so they could do that with impunity. Now there's a repercussion, so I think we're kind of caught in the middle here. It's going to be a volatile market as we ascertain what's going to happen with inflation and interest rates.
More volatility then. Eric, one of the main questions now is if Powell will be able to control inflation and avoid a recession. The recession calls are getting louder on the US, but for many of the households and businesses, this downturn is already here. And we've seen how the US yield curve inverted again. Is the US already in a recession?
It very well could be. It's a great question. It very well could be based on the preliminary data from the GDP print from Q1 and what we discussed with the preliminary data for Q2 in terms of the GDP measurement. So we very well could be. At the very least, we're slowing. That's not surprising. It's not just monetary stimulus. We have to remember that there were trillions of dollars of fiscal stimulus associated with the pandemic that is winding down. And so clearly, between the monetary and the federal and the fiscal stimulus, there was over 50% of GDP in stimulus associated with the pandemic. So as that's rolling off, it wouldn't surprise us if we were entering a recession either now or certainly within the next 12 months.
And Eric, you mentioned that the Federal Reserve has two mandates. One, it's the financial stability, and the other is about achieving full employment. We are on full employment now on the US, but will the Fed be able to maintain this strong labor market?
It's a good question. It's going to be very hard to thread the needle for the Fed. I mean, one of the things that's interesting is that there's this perception that as long as unemployment stays relatively low, you can stay out of a recession. If you look back at the last 50 years, there's been studies done that have shown that even a half percentage point, so just going from our current 3.6% unemployment rate to maybe low fours, historically that half percentage point rise in unemployment has actually created a recession. So you don't need a lot to do that. We could very well be entering a recession even with relatively low levels of unemployment.
It will be a tough job for the Federal Reserve. Eric Lynch from Scharf Investments, thank you so much for this analysis.
Thank you very much for having me.